Ever wonder why dividend investing is gaining popularity among investors? It's not just a fleeting trend or a buzzword in the financial world. Rather, it's a sound investment strategy that has captured the attention of a diverse group of investors, particularly those in their golden years, looking for a reliable income source during retirement. Dividend investing is like a two-sided coin, offering dual benefits. On one side, you have the allure of substantial dividends, and on the other, the potential for growth over time. This is where the magic of the best dividend stocks lies. They're not just about the immediate gratification of receiving dividends, but also about the promise of a potentially growing investment that can add value to your portfolio in the long run. Think about it. Who wouldn't want an investment that not only pays out cash regularly, but also has the potential to increase in value over time? It's like having your cake and eating it too, and that's what makes dividend investing so appealing. But the appeal of dividend investing doesn't stop there. With current concerns about inflation making headlines and causing jitters among investors, dividend stocks are stepping into the spotlight. Why, you ask? It's because during periods of inflation, when prices are rising and the value of money is falling, dividend stocks can provide a measure of stability and a steady stream of income. This means that while other investments might be losing value due to rising prices, dividend stocks can continue to deliver dividends, providing a regular income that can help offset the impact of inflation. It's as if you're holding an umbrella that shields you from the rain of inflation, keeping your financial goals dry and intact. So it's no surprise that when inflation looms, dividend stocks often become the cynosure of investors' eyes. They're not just an investment, they're a strategy, a way to navigate uncertain economic times, and a path to financial stability and growth. That's the power of dividend investing. Let's hear from Elizabeth E. Evans, a certified financial planner, on the role of dividend stocks during inflation. Elizabeth tells us that dividend-paying stocks have a knack for outperforming growth stocks during periods of high inflation, elevated interest rates, and economic uncertainty. You see, the best dividend stocks have a dual appeal. Not only do they deliver substantial payouts to investors, but they also offer potential for growth. And in times of inflation, this growth potential becomes even more crucial. Think about it. As the cost of goods and services increases, investors need their assets to grow just to maintain their purchasing power. And that's where dividend stocks come in. They provide investors with a solid income stream that can keep pace with rising prices. This is why dividend stocks are becoming a go-to for investors in today's economic climate. How do savvy investors maximize their returns from dividend stocks? The secret lies in finding sustainable dividends. But what does sustainability mean in the context of dividends? Simply put, it refers to a company's ability to maintain or even increase its dividend payouts over time. This is especially crucial during periods of economic downturns or short-term business declines. In the world of dividend investing, sustainability is king. Companies that consistently pay out dividends are often seen as more financially stable. These businesses typically have a strong track record of generating steady profits, and they are confident in their ability to continue doing so in the future. One of the key indicators of dividend sustainability is the dividend payout ratio. This is the percentage of a company's earnings that it pays out to shareholders in the form of dividends. A lower payout ratio often signifies a more sustainable dividend. Why? Because it suggests that the company has ample earnings left over after paying dividends, which it can use to reinvest in its business, pay down debt, or weather any financial storms that may come its way. However, a low payout ratio isn't the only thing to look for. Investors should also consider a company's overall financial health, its competitive position within its industry, and its potential for future earnings growth. An excellent way to find sustainable dividends is by looking at companies that have a history of regular dividend increases. These are often referred to as dividend aristocrats. These companies have demonstrated their ability to grow dividends over time, which is a good sign of sustainability. Investors should also be wary of companies that offer unusually high dividend yields. While these may be tempting, they can often be a sign of financial distress. A high yield might mean that the company's share price has fallen due to concerns about its ability to maintain its dividend payments. So, while a high yield can be attractive, it's important to dig deeper and examine the underlying reasons for the high yield. Remember, sustainability is key when investing in dividend stocks. By focusing on companies that offer sustainable dividends, investors can enjoy a steady stream of income, and potentially significant capital gains over the long term. What's another secret to maximizing returns from dividend stocks? It's the power of reinvesting dividends. This is not just about receiving cash payouts, it's about using these dividends to purchase more shares of the stock. This strategy can significantly enhance portfolio growth through the magic of compounding. Consider this. Each time a dividend is paid out and reinvested, you acquire more shares. The next time dividends are distributed, you receive payouts on a larger number of shares, which can then be reinvested. This cycle of reinvesting dividends creates a snowball effect, gradually increasing the size and value of your investment over time. Interestingly, over 40% of S&P 500 returns since the 1930s can be attributed to dividend income. That's a substantial chunk, isn't it? This shows how reinvesting dividends can provide a cushion, offering a degree of stability during periods of market volatility. Remember, reinvesting dividends can provide stability during market volatility. High yields are tempting, but are they always the best choice? It's an understandable allure. Who wouldn't be drawn to the promise of big returns? But in the world of dividend investing, it's not always as straightforward as it seems. High-yielding dividend stocks can often signal a lack of market trust in a company's ability to sustain those payouts. This lack of confidence can lead to depreciation in stock price, potentially eroding any gains made from the dividends themselves. Think of it as a siren song, enticing, but with potential dangers lurking beneath the surface. It's not that high yields are inherently bad, but they do come with their own set of risks that need to be carefully considered. For instance, some high yields may be the result of temporary one-time distributions rather than regular sustainable payouts. So, while the initial attraction might be strong, the long-term reality could be less than ideal. Investing in the highest yields can be a risky venture. So if not the highest yields, what should investors look for? The answer lies in the power of dividend growth. While high yields might be alluring, it's the dividend growth that holds more weight in the long run. Why? Because this growth can shield your portfolio against the rising costs of inflation and other market uncertainties. In other words, if your dividends are growing at a rate that surpasses inflation, your income stream remains intact and even grows over time, regardless of economic conditions. But how do you find stocks with solid dividend growth? Let's dive into 3 key factors: the dividend payout ratio, the dividend growth rate, and the earnings growth rate. Firstly, consider the dividend payout ratio. It's a measure of how much of a company's earnings are paid out as dividends. A lower ratio suggests that a company has room to increase its dividends in the future. However, a high payout ratio could signal financial strain, making future dividend hikes less likely. Next, take a look at the dividend growth rate. This reveals how quickly a company's dividend has grown over a specific period. Companies with a consistent history of dividend growth are more likely to continue that trend, offering investors a steadily increasing income stream. Lastly, don't forget about the earnings growth rate. After all, dividends are paid out of earnings, and a company can't sustain its dividend growth if its earnings aren't growing. Therefore, a strong earnings growth rate can be a good indicator of future dividend growth. In summary, while yields might catch your eye, it's the dividend growth that should captivate your investment strategy. By focusing on the dividend payout ratio, the dividend growth rate, and the earnings growth rate, you can identify companies with the potential for robust dividend growth. And remember, it's this growth that can shield your portfolio against rising costs. So always keep an eye out for dividend growth when making your investment decisions. What's the final secret to successful dividend investing? It's as simple as buy and hold for the long term. While the hustle and bustle of the stock market might make it seem like a game of quick wins and losses, dividend investing is a marathon, not a sprint. It's about understanding the value of patience and the power of compounding. Each dividend received and reinvested brings you one step closer to your financial goals. When you buy a solid dividend stock and hold on to it for the long haul, you're not just investing in a company. You're investing in its future, its growth, and its potential to provide you with a steady income stream for years to come. So when you find those reliable dividend payers, hold on to them. Let time do its magic. After all, Rome wasn't built in a day, and neither is a robust dividend portfolio. Patience is a virtue, especially when it comes to dividend investing.